sold those calls, thought I'd be smart, collected credit, played my part, but stocks don't care what traders say. Now they're exploding anyway.
Each time I check my screen at night, the red is glaring far too bright.
I thought I'd win, I thought I'd thrive, now I'm just praying to survive. Why did I sell those options for pennies? They promised easy gain. Why did I sell those options for pennies? Now losses drive me insane. Option sellers eat like chickens, sure, but bathroom time's an elephant chore. Picking up pennies before a steamroll. One bad move and it swallows me whole.
And when the broker calls my phone, I know I'm standing all alone.
No safety net, no place to hide. The risk was always magnified. Why did I sell those options for pennies?
It's not the game they said.
Why did I sell those options for pennies?
It haunts my trading bed.
They said I'd earn while I snoozed away, collecting data every day. But memes don't warn when stocks go wild. Now I'm the broker's problem child.
Infinite loss, that's what they say. One bad print and I must pay.
I sold the dream, I bought the lie. Now let it last while I just cry. Why did I sell those options for pennies?
It's not the game they said.
Why did I sell those options for pennies?
It haunts my trading bed.
Delta bites and Vega screams. Vandals, my fragile dreams. There's one more Greek they all forgot. Trumpers, queens can wreck the lot. Why did I sell those options for pennies?
The credit's never free.
Why did I sell those options for pennies? Then Trumper tweeted on me!
Good morning, Outliers. It's a great morning because Chris has a new obsession that I'm excited about. So yesterday, Mahesh and I, we were having a conversation, our normal weekly meeting, and Mahesh suggested taking a look at once a trade reaches 3 ATRs, and we're jumping straight into it. Sorry for the not pleasantries here. I'm excited. Once a trade reaches 3 ATRs, which is our average peak on the winning trades for plan M, consider reducing size. And I love smart people. Mahesh is definitely one of those smart people that I love. And because of that, I started looking at it, right? I couldn't sleep. I literally got in bed last night and I was jotting down my notes about it. First thing I did when I woke up at 5 a.m. was jump up, run on the PC, start doing data on it. Preliminary results are promising. I'll share all kinds of details. In fact, in the Discord, we have a testing new strategy section, and I built my own thread specifically on this topic because I think this could really enhance our expectancy, which is the goal, right? It is okay to adjust your trading plan if you have a reason to. If you're doing it just because I'm scared of what happened, I don't want that to happen to me again, that doesn't count. Okay. You got to have the data to back it up. So preliminary results are good, but I got a lot of testing that I got to go through. All right. I got literally 7,000 trades that I got to test this on. I'm on like 5. And so far, so good. Basically what I'm doing is I'm measuring. Now, again, not sorry for going full bore into it because this is how my mind works. What I'm doing is I'm measuring from 0.0 to 0.3 on ATRs. How much is that in profits? And then I'm assigning a theoretical trade of 10 contracts. That way I can peel them off one at a time, right? So that's where I'm at right now. Is I've calculated what the wins would, and this only applies to winning trades. And it only applies to winning trades over 3 ATRs at some point during their life cycle. It doesn't apply to losing trades, and it doesn't apply to winning trades that are less than 3 ATRs during their life cycle, which is 39% of the winning trades this would apply to, just so you know. So 39% of the trades this would apply to. 39% of the winning trades this would apply to. So 61% of the trades we wouldn't even worry about. So calculating that point from 0 to 3, what the profits look like on that, and then taking from 3 to 4 and giving that 0.9. So basically taking off 10%, which is where I'm starting at. This is not set in stone. Where I'm starting at as far as the what the return would be for the 3rd to 4th ATR, and then comparing that to the original trade outcome, what that would have been. As you can tell, I'm a finance bro. I'm a nerd, and I'm an actual trader, right? Unlike all these other jokers on YouTube. And I obsess over this because my thought here is if I can increase my expectancy, that means I make more money. That means you make more money. That means everybody is better off because of it. So this is why I obsess over things like this. And I love it. Oh my gosh, I love it. Rick, I was wondering whether when concentrated in a sector, we could reduce size in the trades that are doing less good and keep the leader at full size. That reminds me of the how I made $2 million in stock market, right? He'd buy the whole sector, the whole industry, I guess you could say, and then he would just peel off ones that stopped working. And that's my number one concern too, because some of these, and because it has all the data, Mahesh has asked me not to share this. So I'll share what I can when I can. Because some of these would go like 36 ATRs. Could you imagine what it would be like to be in a trade that goes 36 ATRs in your direction? Oh my good gravy. Oh my good gravy. Guys, share the Discord link, please. Nothing on the website and description. Pale man, get an OVTLYR account first. All right. The Discord is not for randos. All right. The Discord's not for freeloaders. The Discord is for the people who have spent all of 82 cents a day to get here. And then it's right there on the platform. Like you can't miss it. In the bottom right corner, there's the Discord link. Boom, you're in. Plus, if you try to get in and you're not a customer, you'll get bounced out. You'll get bounced out. How do you know which one to peel off? So I get to use one of my favorite words that I don't get to use very, very often. They're fungible. I got to explain what fungible was to my children the other day. So let's, and this is why I said I'm starting everything with the 10 contract position size just to be able to start peeling them off, right? They're fungible. All 10 of them are going to have the same value at 0 to 3 ATRs. I can just peel any one of them off, right? Just peel any one of them off because they're fungible in this case. Okay. So this is my current obsession. Like I'm not going to be able to sleep. I'm not going to be able to go to the gym. I'm not going to be able to do anything except think about this. But this is my favorite part of trading. My favorite part of trading is acting like a detective, which is what I'm doing exactly right now. We're investigating the crime scene. Where can I find the clues to solve the murder here? All right. 36 rolls makes you a Brazilianaire. Yeah. No, you're fungy. No, you're fungy. Cam's working on another thing we're testing too, which is looking at the, in fact, Cam, I was dreaming about you, well, not in a weird way like that. I was thinking about the project you're working on and how what Cam is working on is actually really clever. And I really appreciate Cam. Cam, by the way, you have an open invitation to the Charlie class. Like there it is right there. Cam is going to be part of the Charlie class, assuming he has time for it. Sounds like an awesome plan to increase expectancy if the numbers look good. Let's try it. Yeah, and that's the thing is we're not going to do anything unless we yeah, I know, not in a weird way. Shut up. We're not going to do anything unless it increases expectancy. Period. Full stop. There's no trust me, bro. There's no, oh, I think this is a good idea. Let's try it. It's if it makes sure to make sure, or if it does increase expectancy and the data proves it out. All right. Good way to focus with OCD. Shut up. It's the Chris Chain stock investigation. Okay. We are going to watch this video. Now, we watched a video from this channel previously, and I almost rage quit, but I'm glad I didn't because it ended up being actually great. It ended up being a fantastic video from Bar Chart. Now, I've got history with Bar Chart in a good way. As you guys know, random guy on the internet with 2,000 plus videos. I used to be, I guess you could call it, sponsored by Bar Chart. I was a Bar Chart, what do you want to call it? Influencer. I don't have any business with them anymore. But they did send me some cool swag. My computer bag is actually a Bar Chart backpack. And then they sent me some like Yeti cups and cool stuff like that. So I have good feelings towards Bar Chart. And this one I'm really excited about. I think this video is going to talk about deep in the money long calls, because the title of this video is The Options Hack Wall Street Hates. Trade any stocks for pennies. Now, this very well might be deep in the money calls, which is how I like to trade. So this could be fantastic. I have no idea. I'm going to watch this cold with you. All right. Y'all ready? All right. Let's do this here. And we'll do this over here. No. Okay. I saw a lot of fear mongering yesterday about this, the market's crashing. Did y'all see that? I don't know if y'all saw this. I saw a lot of fear mongering about the market crashing. And I'm like, did it though? Because it looks like it crashed to levels not seen since the day before. What? The market on Tuesday crashed to levels not seen since Monday. Yeah, I don't know. Professional investors don't care about that kind of stuff. All right. The Options Hack Wall Street Hates. How to trade any stock for pennies. Okay. Today, we're going to watch a video called The Options Hack That Wall Street Hates. How to trade any stock for pennies. Now, I am a professional investor competing in the U.S. Investing Championship in 2026. All of my trades are in a Google Sheet trading plan. If this is a viable strategy, I'm going to backtest it. I'm going to prove that it works, and I just might add it to that trading plan. So I'm very excited to watch this with you. This is coming from the Bar Chart channel. Let's watch it together and learn.
What if you could buy $18,000 of stock for just $200? Would you do it?
Bro, there's no way he's not talking about deep in the money long calls. I can hear it right off the bat. There's no, the reason, okay, look, I'm hopped up on Sudafed and Celsius. You know the deal. Going over to options grid. Right. The way that I look at trading when I go deep in the money long calls, in fact, let's go to the one I still have open so you can see the position that I have. This one here. Oh, it's out of the money at this point because it fell so hard. But let's imagine that I'm in the 84 delta right now. Okay. Let's imagine that or 69 delta, whatever the case. It's moving around a lot because I haven't had my exit signals yet. So I'm not stressed on it. But when I look to trade a stock, this is a $117 stock. And if I'm purchasing it for $11.40, that is what I consider I'm purchasing the stock for $11.40 per share instead of $117 per share. So I think that's where he's going here, which I'm very excited about.
Well, you can't exactly, but you can almost do it. With the options market, you can create synthetic positions on stocks or ETFs for a fraction of the cost of what it would be to buy the underlying outright. Options create passive income, can be used as a hedge against losses.
Hang on. Strike that. Forget what he said about passive income. Never treat options like income. I'm just saying. By the way, Drum Dave says, I appreciate you outliers. I'm finally discovering what I've needed for years. Everybody say, what's up, Dave, in the chat. Everybody say Dave in the chat. Dave, I'm glad you're here, my friend. Glad you made it.
And, of course, it can mimic a stock position for a fraction of the price. And
Okay. Mimic a stock position for a fraction of the price is deep
Of
in the
course,
money
it
long
can
calls.
mimic a stock position.
This is what I learned from a billion-dollar hedge fund manager. Right? Larry Height specifically taught me exactly this. Not that, not that, this. This is where you need to be. Don't worry about hedging. A lot of people love the idea of hedging. Oh, if I buy puts while I own the stock, then as the stock goes up, it's fine. I don't care if I'm wasting the money on those puts. Every single month I buy a put and it just expires worthless and I've wasted money. So my entire gains are offset by the amount of the puts that I buy. I'm not worried about that. If only the price of the stock goes down, then those puts will pay. If the price of the stock goes down, just get out. There's no need to hedge ever. If the trade isn't working, just get out. That's it. Okay. And then passive income is a very, very, very dangerous approach to trading. I would anybody who tells you to trade stocks for passive income has no idea. They have not been hit by the monkey hammer yet. Or if they have, they don't make any money in the markets and all they do is sell courses and that's how they make their money. Nobody makes passive income in the market. So let's continue on with this.
Position for a fraction of the price. And these are called synthetic positions, and they can be very powerful tools in the right hands. They allow traders to replicate the risk and reward profile of an underlying position with a fraction of the capital you
He's talking deep in the money long calls, for sure.
normally need to get into the trade. In this video, I'm going to be covering what synthetic positions are, why they're helpful, and of course, I'm going to break down the strategy.
That sounds great. That's what we do twice a day, every day. By the way, promo code for annual subscription, you don't need a promo code. Just go to outlier.com, pick up the annual pass. It's $2.99 for the year. That's 82 cents a day. There's no promo code that you need for it. You're just in. How's that sound?
But before I dive in, let's make sure we're all on the same page. Options are financial derivatives. They're contracts that allow you to buy or sell a specified asset at a specific strike price at or before a specified expiration date. When you're buying an option, you pay a premium. If you're selling, you get the premium, which is usually expressed on a per share basis.
So the premium in this case is always tied to your extrinsic value. Remember, there's intrinsic and extrinsic. Intrinsic is calculated from the difference in, let's pull up the handy dandy calculator here. And we'll just go to that one because I got it highlighted. The difference between the current price and your strike price. So 117.14 minus 110 gets you $7.14. Oh my good gravy. I know my math. Okay, that's your intrinsic value. That's the moneyness. That's not your premium. Forget that. This is how worth the investment is worth. This is how rich the investment is worth. We're trying to take an already valuable asset and make it more valuable. The extrinsic, that is the premium you pay. Now, one thing you'll notice when you look at an options chain is that the extrinsic value peaks and goes down at the money. It peaks at the money because this is the most uncertain point on the options chain. This right here, there's a 50-50 chance of being in the money or out of the money expiration. So you can see down here, $1.72, $1.96, right? It peaks right here. That is the most premium you can pay. I want to pay as little premium as I have to. My rule of thumb is I want to be around 20%. So 381 on 1140 gets you 33%. So for me, I wouldn't trade this strike because the extrinsic value is too high. So what I would do is I would just walk up the options chain to maybe right here, and it's 226 divided by 1515 gets you 14.9% extrinsic value. But Chris, it costs so much more. It does. You're right. It does. Because this has $7 of intrinsic value. This has $12 of intrinsic value. Remember, we're trying to take a valuable asset and make it more valuable. You pay extra for that because it's worth it. You just went from 1/3 of your contract being premium that will expire to 15%. So less than half of how much on the percentage terms will expire. Every single option on every single stock on every single time, period, full stop, no matter what, will always expire on the extrinsic value. Always expire at nothing. $0.
It's all there, black and white, clear as crystal. You get nothing. You lose. Good day, sir.
So if you go out of the money and it expires out of the money, you get nothing. Good day, sir. If you go in the money and you go deeper in the money, the percentage of the total price goes down. And that right there, I saw you guys in the chat saying it. That right there is a
Pro tip.
That's your pro tip of the day. All right, let's keep going. As you can tell, I'm jazzed for this video.
One option contract represents 100 shares of the underlying asset. Now, when it comes to options, we can also replicate the desired result of an underlying, like a stock or an ETF. Synthetic positions typically mimic holding an underlying asset, but they can also replicate an option strategy. They allow traders to mimic the risk and reward profile of the target position with less capital or different risk characteristics. Now, let's start with the most common synthetic setup, the synthetic long stock. A synthetic long stock is an option strategy that mimics owning an underlying asset. The strategy involves buying a long call.
Yeah, I was about to say, I think it's where you buy a long call and you sell a short put against it. I don't understand why you would do both, but whatever.
And selling a short put with the same strike price and the same expiration date.
So let's look at what that would look like. So buying a long call, I assume it's any long call. So let's go with my deep in the money long calls. And then you sell a put at that same expiration, at that same date. And then I think you can go to this button down here, send to what if. Ooh, this is actually kind of cool. And it will do a P&L graph over here to show you what that looks like. That's kind of cool. Okay, so you have unlimited gains like you would with a long stock, but you also have unlimited losses because you sold that put. But in theory, at today, if it goes up in value, you make money. Okay. Now, let's say that we drop off the put, then we send this to what if. This will just look like a long call. Okay, there you go. Now, we see that there are losses, which are still possible with either one of these scenarios, but these are capped. These are capped. It can't go against you further. Okay. But in theory, if it needed to expire, it needs to move up this amount, the amount of premium you paid, which is the amount of extrinsic value you paid, not the amount of intrinsic and extrinsic, just the amount of extrinsic, in order for it to break even at expiration. We don't hold these things to expiration. We get these moves faster. In fact, I believe if I do this, I change this to, that's today. I want to be able to will this work? This is not doing what I thought it would. That's okay. I wanted to show you what it looks like, right? If the stock is moving earlier than expiration, you get those profits earlier. Okay, anyway, let's keep going.
What this basically does is it anchors you to the strike price in the same way your purchasing price does when you buy a stock. The only difference is that you pay for the long call and the short put essentially subsidizes the purchase of that long call. It means you get control of 100 shares while paying a fraction of the cost of the stocks themselves. Now, if the stock increases in value and exceeds your long call strike price, the option is now in the money and your position begins to generate a profit. Like with holding a stock, your maximum profit is unlimited. Now, if it doesn't work out and the stock moves down instead, well, there's a twist. If the stock price moves below your short put strike price, that option will now be in the money. And on or around expiration, you'll now be buying 100 shares of that stock at your strike price, which you can either keep or sell at the current market price and take a loss. Let's explore these concepts with a live example with NVIDIA as the underlying. Let's say you're bullish on NVIDIA and you think there's a big chance that it's going to reach new highs in the near future. So let's look at creating a synthetic long position on NVIDIA. First thing you do is go to barchart.com if you are already there, search for NVIDIA up here, and then go to the stock's profile page. From there, look to the left side of the screen and click on long call/put under option strategies. You'll be brought to the option screener for long calls, where you'll be able to find trades for the nearest expiration date, along with other information like probabilities, percentage returns, and the Greeks. By the way, I made a full deep dive covering the options Greeks, so you may want to check it out up here. Going back, The first thing you need to do is consider your expiration date. Let's say you want to enter a synthetic long on NVIDIA that expires in about 3 months. For that, we can pick December 19th, 2025, or about 81 days from the time of recording. Then you need to decide on your strike price. Now, synthetic long stocks are usually set at the money to closely mirror the behavior of the underlying stock today.
Okay. So it's not the deep in the money area where I hang out. It's at the money. I'm glad he clarified that. So buying a long call at the money, selling a short put at the money. Okay. So this actually results in only a 60-cent debit. 60 cents debit, right? Rather than $7.55 to buy it. 60-cent debit looks really good. And if we go to send to what if, we'll see it looks just like if you own the stock outright. Yeah, right. If it goes up, then you make money. If it goes down, then you lose money. Okay, 60 cents in debit. But that's not the whole entire story right here. Now, as great as this sounds for 60 cents in debit, you're going to have to put up the margin for that put. You're going to have to put up the margin for that put. So I'm actually curious if this will show me what my margin requirement would be. Break even max profit. Margin, 35.09. Wait a minute. That's a hell of a lot more than 60. Yes, that is. That's significantly more than 60. Generally, what I have heard, and we're about to find out here in a second, this is, 35.09 is your margin change, but it's going to cost you 35.69 because of the 60 cents debit. Okay. So if NEM, what is the price of NEM right now? Does it tell me? I see NEM's price anywhere on here. No, let's go back to trading. NEM at 117.14. Okay. So 35.09 divided by, all right, let me do divided by 100. Didn't work like I wanted. 35.09 divided by 117.14 gets me 29. So basically 30% margin. Okay, that solves it. So it's 30% margin, at least on this broker here. So it's not 60 cents. It's not. You're tying up 30% as if you were to buy the stock outright. Now, this is a big difference here. This is a big difference here. Okay. Now, let's say that 30% margin gives me 35.09. Okay. Now, let's say that I went with the deep in the money long call right here. That'd be 15.15. Right? 15.15. Deep in the money. We'll call it 15.15. That's about half. Less than half equals this divided by this. That's 43% of the margin for a very similar trade in the outcome. I'm going to stick with this. I'm just saying. I'm going to stick with this because what can I do with the other $2,000 here? Anything I want. I could actually put on another trade, another 15.15, and still the sum of this gets me to 30.30. So I could have twice the position size for the same amount of margin. Does that make sense? If that makes sense, put a thumbs up in the chat. Not a thumbs down, a thumbs up. If that makes sense, put a thumbs up in the chat. Just like this. Okay. And no assignment risk. Great point. Okay. So I don't think I'm going to be changing over to this for now. For now. I don't know. Things could change. Let's keep going.
This will give you nearly identical gains and losses if you would own the shares outright. Since NVIDIA is trading around $181 today, let's look at the $181 strike long call.
Okay, Charlotte, I'm actually really glad you asked this question. Charlotte, one of our Bravo students, soon to be a graduate of OVTLYR University. I'm not understanding why margin is involved. Okay, so let's recap this. I hope this makes sense. When I buy this one, right, and now prices have changed because the market opens. The total max loss I could possibly make if the stock goes to absolute zero is I lose both the intrinsic and extrinsic. So I lose what I paid for it, which in this case would be $14.50. That's the most I can possibly lose. But let's say that this stock goes to absolutely zero when I bought the long call and I sold a put. Let's say the stock goes to absolute zero. In that case, we're not limited by this $15 a share, which basically means if it goes to 120 minus 15, if it goes to 105, then we're basically at zero. But if this goes to 0, we now owe the entirety. We instead of owing $15, we now owe $120. So they're not going to be like, okay, well, we need 100% margin. We're 100% margined on this one here because we know our max loss will be. We're only 30% margined here because we don't know how much our max loss will be. We don't know how much that max loss will be. Okay, if that makes sense, put a fire emoji in the chat. Put a fire emoji in the chat. If it's still not clicking, put an X. Put an X. If it's still not clicking, put an X. Yes, this breaks the golden rule of leverage. Absolutely, it breaks the golden rule of leverage. Good job, Lucky Chevy, for recognizing that. Let's keep going. Oh, by the way, for those who don't know, what is the golden rule of leverage? Never put yourself in a situation where you can lose more than you can make. And in this case, absolutely is the case here, because you have that naked long call. I'm sorry, that naked short put combined with the long call. You are setting yourself up in a situation like that. All right, I see lots of fire emojis, but a couple X's. That's okay. We'll continue along and maybe I can make it make sense.
By typing 181 here and then click apply. And there we go. This $181 strike call costs $14.95 a share, or $1,495.
Remember, this is fully margined for you. This is the most you can possibly lose. But if you sold the long put, in theory, the most you could lose is the full 181. Okay. So when you buy the long call, this is how much you pay. This is the max you can lose. When you sell a short put, this is how much you can lose. They're not going to make you put up, in this case, $18,000. For this broker, and all brokers are different, they're only going to make you put up 30% of this $18,000. All right.
Per contract. You can also see other trade metrics and figures right here. Now, that's it for the long call, but what about the short put? Well, you can simply click on naked put and you'll be brought to the naked put screener page for trades.
We need to have so imagine that this is like a movie that they're airing on TV and it's blurred out over the naked parts, right? We need to blur this out over the naked puts.
That also expire on December 19th.
Oh, avert your eyes. Avert your eyes.
Now, all you need to do is type in 181 on the strike search box and you have your list. According to the screener, you can sell a $181 strike put on NVIDIA and receive $12.30 a share, or $1,230. So
you would take in, but you don't get to keep it until the trade is closed. And I hate how people want to act like this is your passive income. Not at all. Not in any way, sense, or form. If you're selling puts, in theory, this goes into your account. This is the absolute max that you can make on a put that you've sold. But remember, if you're selling it naked, this is not the absolute max that you could lose. In fact, the absolute max you could lose is this times 100. Rick never trades naked, right? And I don't wear pants, so we got a thing in common there.
$30 per contract. Since you paid $1,495 for the call and collected $1,230 for the put, that brings your total net debit to just $265 per contract.
Now, remember, we did this a minute ago. In our example, it came out to 60 cents in debit for a contract. So this is vibing. I can follow along. I'm not saying I love it, but I'm following along.
And this is the magic. It means that instead of paying $18,100 for 100 shares of NVIDIA, you'll only pay $265 for the very same exposure to those same 100 shares.
With the caveat, with a big asterisk off to the side, you're not just paying that. This is absolutely a big asterisk. I hope he explains this, because this is not the truth. It's $265 is what you're paying for it, in addition to the margin requirement of this times 30%. So 18,100 times 0.3. You're actually spending $5,000 in margin, which will be tied up and for the duration of the trade, plus $265. So you're actually tying up $56.95. This is what I care about, right? I don't care what the debit is. If I've locked up $5,700, that's what I care about. That's $5,700 that I'm stuck in this trade with, right? Everybody make sense? Cool.
for the very same exposure to those same 100 shares. Now, before you run off to your brokerage and enter into one of these positions, remember that when you're selling puts, your brokerage
Oh, there it is.
will require you to maintain enough cash or margin to cover the potential purchase of the shares if you're assigned on the short put. Because remember, synthetic replicates both the upside and the downside of the underlying. Now, let's see how this plays out if NVIDIA rallies. Suppose the stock jumps at $200 before expiration. Well, now your $181 strike call has intrinsic value of $19 a share. Can you calculate that
Which is what we want. We love intrinsic value.
by taking the current trading price minus the strike price? That means your call option is now worth at least $1,900. You could exercise the option.
Anybody see the flaw there? Anybody see the flaw in logic here? Yes. You're right. The long call you bought is worth $1,900. You're totally exactly right. But what happened to that put? What happened to that put that you sold? It's losing money on the way up. This is not a one-sided equation. In this case, you're actually having to think about both sides.
Buy 100 shares at $181 each, and then immediately sell them at $200, making you a nice $1,900 gross profit per contract. And since you initially paid a net debit of $265 to get into the contract, your net profit is $1,635. But exercising isn't usually the
But you didn't pay $265. You paid $265 on debit, but you still locked up $5,800 in margin. That's where I look. That's what I care about. That's margin I can't do something else with. So therefore, it is tied specifically to that stock.
the most efficient way to capture value, because options also carry extrinsic value, or the part of the premium that accounts for factors like time to expiration, implied volatility, and market demand. So instead, you might just sell the call back to the market. Let's say it's now priced at $20.50 a share. That's $2,050 per contract. Since you initially paid a net debit of $265 a contract to get into it, your net profit works out to $1,785. And don't forget, you also have a short put in play. Since the stock rallied, the short put will now be worth a lot less than you paid. So if you believe that NVIDIA will stay above the strike price at expiration, you can let the option expire worthless. Or
No.
you can issue a buy to close order to close that side of the trade.
Yeah, Charlotte, it is absolutely an expensive way to trade. It's a lot less expensive, but let's unpack that a little bit. Let's unpack that a little bit, because I think you're onto something, Charlotte. So typically, when you buy a stock, if you're just to buy the stock outright, they will charge you 50% in your margin. Wait, what? Typically, I'm not saying your broker will, but a lot of times brokers will give you twice the amount that you have in your account. Basically, it's a good faith of you're not going to let this go to zero, right? Right. And the people who lose more than 50% on a trade, those are the ones who get the margin calls. Okay. Now, you're not going to let this go to zero because you're an outlier, of course. But let's say that I buy the stock at 119. I'm not going to have to put up 119 in margin. Actually, going to have to put up 59.50. But is it really that much better to do this synthetic long call? I'm sorry, synthetic stock? Because if this is 50% of my margin and this is 30% of my margin, yeah, it's better, but it's not as good as taking up a very small percent of my margin by buying the deep in the money long call, which may be like 7 or 8%. Let's keep going.
But what about the downside? Well, if NVIDIA drops to, let's say, $170 at expiration, now your $181 strike put will be assigned. It means you'll...
So yeah, Texas Brian, this method requires less capital. Totally agree. We're both on the same place, Brian. I'm not saying it's better, but that is the difference. I guess. And if at the end of the day, that is the judge between if this is better or not better, then yeah, totally, for sure. But like Cam says here, the put selling seems unnecessary. Spot on. If the technical analysis points to the option potentially going up, just buy the long call when ripping up. Why increase the risk and tie up capital? Dude, Cam, exactly. That is my exact same ideal right here, right now. It costs more, not in debit, but in margin. So therefore, you can put on less trades, but it does mimic the stock outright versus the long call. But if it goes down, it mimics the stock outright, not like the long call, which has a capped loss versus an unlimited loss. So, okay. Yeah, I thought that too, Cam. 100% on Cam.
You'll be obligated to buy 100 shares of NVIDIA at $181, even though the current price is $170. And since you paid a $265 net debit to set up the position, your total net loss is $1,365. Now, you will still have a call option that you can sell, but its premium will have probably eroded significantly. Selling it may help reduce your net loss, but it may not be worth it, especially if the trading fees exceed the premium. And there's your trade-off. If you had owned the shares alone, your loss would have only been $1,100. Let's consider the profit and loss scenarios depending on where NVIDIA might end up at the option's expiration date. For this synthetic long position, the break-even is the strike price plus the net debit or credit. In this case, it works out to $183.65. As you can see, the only difference between having the synthetic long stock and owning the stock outright is the $265 debit in this case.
So still, buying the long stock on its own is better than making this synthetic long call because of that 265. You spend more in margin, you spend less in margin, which I'm sure that there is a breakover point where it makes sense to do this in return on the margin. But I don't know. I don't love this strategy. Is there more to this? Still advantages and disadvantages. Okay. So let's wrap this up here. It is a viable solution if you wanted to go long call. I agree with that. It does cost less than margin to do it this way. I agree with that. However, I think the deep in the money long call is the better way to go. Now, of course, you do need to pay attention to the fact that there will be extrinsic value erosion. There will be. But if you go deep enough in the money, it's such an insignificant part of the overall trade, you don't have to worry about it. Plus, you can roll these bad boys. Can't really roll this synthetic option over here. And as we talked about last week, definitely want to go check out that video. I think the video is called How I Hacked Silver as it crashed and I Still Made Profits, right? Because I rolled, I ended up in a profitable trade while the stock went down. In fact, I think I still have I do. Yeah. So had I not rolled any of these, I would have been negative 22% on average. But because I rolled these, my average return was 11% per. Even with a losing trade here, I still ended up with an 11% gain on average by rolling. And you can't do that. You can't do that with stock, and you can't do it with the synthetic long stock. So I'm not saying I'm smarter than him, not in any way, shape, or form. And this is not, I'm sure that he's just giving an example, not saying that he trades this way. But as an actual active trader competing in the US Investing Championship, there's no way I'm trading. There's no way I'm trading the deep in the money long calls for the synthetic longs. It just doesn't make sense to me. But you know what? Maybe it makes sense for you. And of course, tell me in the comments down below why this makes sense to you, or if you're going to change your trading style in any way. Options Deep Dive Wednesdays is one of my favorite things to do. I can nerd out so hard on this kind of stuff. And if you're ready to save time, make money, and start winning with less risk, click one of these two videos. Have a fantastic day. We'll talk soon. All right, there we go. I don't know. I'm not changing what I'm doing. Oh, Brian Anxiety. Chris teaches us clearer than any other professional YouTuber. That's why I'm here. Thanks, Brian. And if you have a margin account, you could just buy it on margin. Yeah. And that's where the 50% would be. So yeah, you do tie up less margin. I agree with that. You do tie up less margin. But that's about the only advantage that I can see. That's about the only advantage I can see. All right, let's go through our trading plan for the day. Literally have not looked at this. Oh, we got an NEM sell signal today. Is that the one I'm still in? Yeah, sweet. Okay. So I have to sell and close NEM today. This is a must do for sure, no matter what, period, full stop. When I do this, most likely I'll be buying some SPXL for playing ETF. If we're in the value zone. Are we in the value zone right now? We are not. We are outside the value zone right now. The value zone is the 20 EMA, If it closes above the 20 EMA, everything else is good to go. So we'll have to wait and see by the end of the day. If that does not happen, I'll be buying SGov with the proceeds from the NEM trade. So that's my plan for the day. Not everything has a sell. SPY still has a buy. SoFi. I want to go look at SoFi. SoFi is going to be such a fun watch as it crashes back through the stage 4 downtrend. And I want you to tell everybody you know, anybody who makes any video on SoFi about how brilliant of an investment it is, I want you to go tell them Chris has been saying for a hot minute that SoFi has entered a stage 4 downtrend. We're looking at the 50-80 rule. David beat me to it. 50% of the time, a big move up like this can fall by 80%. 80% of the time, it can fall by 50%. This may just be the start. Where's 50% down from here? Around 16 bucks. All right. I want you to tell everybody you know, the market cycle is real. In fact, we have a new song from Rick about the market cycle. I have not listened to this yet, Rick. I'm very excited to listen to this. You guys have a fantastic day. Definitely check out Rick's song about the market cycle, and we'll talk.
We're pacing the room with the lights turned low, waiting for something we don't yet know. Slow days, no plays, drifting both ways, and nothing's wrong, but nothing's sure. Stock goes sideways, then it runs. The trend stops, then it comes undone. The market cycle ebbs and flows, exactly when nobody knows. The doors swing open, the air feels new. Every green candle feels earned and true. High tide, wide-eyed, carried inside. Belief through euphoria, all collide. Stock goes sideways, then it runs. The trend stops, then it comes undone. The market cycle ebbs and flows, exactly when nobody knows. The upward trend feels like it's stopping. EMA's begin their crossing. Laid by same highs, dressed up goodbyes. True believers still eulogize. Stock goes sideways, then it runs. The trend stops, then it comes undone. The market cycle ebbs and flows, exactly when nobody knows. Gravity remembers our names. The floor drops out, nothing feels the same. Time slow, oh no, everything must go. Stand aside as the shadows grow. Stock goes sideways, then it runs. The trend stops, then it comes undone.